Thank you, everybody. Thank you for joining today for our weekly class, SDIRA classes. We have these every single week, so we really appreciate you guys joining on. And keep in mind, you can also review these classes at any point in time on our Facebook page or even our YouTube channel. So before we get into the meat of things, I want to quickly just talk about a little bit about Quest, a little about the things we have going on, just to explain to everybody things like, our Quest Expo, classes coming up, and things that you guys can take advantage of. So let's jump right into it. So quickly, for anyone watching this that is a newcomer and maybe just heard about Quest, maybe is a brand new Quest client, a little bit about us. We are the largest self-directed IRA custodian in Texas. We have over 20,000 active investors, $2 billion under management, which, by the way, a good chunk of that is in cash, and 100 employees with 34 or so certified IRA services professionals. So you'll be hearing from two of those today, or I guess myself now and then T later. A little bit about us that we cannot do is we are not CPAs, advisors. We cannot give you advice. What our job here is to do is educate you the best we can on multiple topics so you can utilize our services and decide for yourself what's the best course of action for your self-directed IRA. A little bit about the investment choices that we see very commonly, and we'll talk about a little bit about those today, are real estate investments, private entity investments, and promissory note investments. So if you're a current Quest client or thinking about becoming a Quest client, these are a little bit about the things that we see very often people invest into. I myself actually invest in the promissory note side of things, right? So even here at Quest Trust Company, a lot of the employees that you'll be speaking to are also investors themselves, which helps the flow of conversation when you're trying to do something and we understand where you're coming from as well. If you do like these ongoing educational courses that are webinars, keep in mind we do multiple different types. This is one of the very many. We have the classes on Tuesdays, we have the classes on Saturdays, we have virtual networking happy hours that happen every fourth Wednesday. If you're someone looking for deals or maybe have opportunities, this is one that I really encourage you guys to jump on every fourth Wednesday at 6:30 p.m. online. Our SDIRA socials are in-person events. We had our first one this month here in Houston. It was a fantastic success. We actually talked about cryptocurrency. In Austin, we have one tonight. So if you're watching and you are in the Austin area looking for maybe some social event to go to tonight and network, that would be a great one to come out to. And in Dallas, we have it every third Tuesday of the month. So it'd be the following week in the Dallas office. Again, all of these are broadcasted live. So if you're watching from somewhere that's not Houston, Austin, or Dallas, you can still join and partake with us. One event I really want to emphasize is our Quest Expo, our annual Quest Expo event. It happens in Houston, September 23rd to 25th. This is not a regular social where some people just go to network and talk. This is a grand scale event, not just solely on IRAs, but on real estate in general. You're going to learn about alternative assets like real estate, like oil and gas, cryptocurrencies, and much more. We have 50 plus investors. We're going to have 800 plus attendees. Tickets are going fast. Right now, you can go to questexpo.com. You can use a discount code, which I'll put in the chat box to get your ticket. This is a big event. If you're looking for your network to expand, this is an event you want to go to. If you're an early investor looking for more education, but you don't want to pay multiple courses, this is one place to get it all. So check out questexpo.com. And then lastly, this is a special week for us, a very busy time. It is tax filing deadline. So if you are an individual who has not contributed for 2021 yet and are looking to get some sort of tax deduction, we want to help with that. We want to give you a free account. So use tax-free 22 when you're opening an account. And this week it will be completely free. Remember, you have until Monday, April 18th to contribute for last year and get that last second tax deduction. Additional questions will be given. We can use our chat website. You can use our phone call, or you just email us, right? Especially at questtrust.com. We'll contact you in about really, honestly, 5 to 10 minutes. If you email us during work hours, we're very fast. So if you have any questions, please reach out. I'll put that information in the chat box as well. That is my last slide. I will go ahead and now start introducing our speaker. So Thi Valdez, this is the individual that I go to in the office with any questions that I personally have. Sometimes when clients ask me questions that are a little bit on the side that I really do not know, or I need help even deciphering tax code, I go to Thi. He's going to talk about due diligence. I think it's very important in the self-directed space, especially for early on investors, that you do your homework and due diligence on investments. because there are people out there, unfortunately, that pry on people with retirement money. And so it's very, very important that we understand what we're jumping into, how to evaluate assets, and how to make sure that we can get our returning our money back at the end of the day, because this is the money we plan to retire with. So Thi, I'll let you take it from there.
Thank you so much, Juan, for that introduction. Yes, today we are going to be discussing ways to mitigate investment risk, and primarily we're going to be focusing on due diligence and how you should conduct due diligence in your account. I did a version of this presentation last year, but I added a few slides because things have changed for self-directed IRAs, and I believe that they will continue to change for self-directed IRAs. So I'm just going to go ahead and jump right into it. Before I get started, Juan gave us this disclaimer, but just to mention it again, Quest does not provide any tax, legal, or investment advice. The information in this presentation is used for educational purposes only. Please consult with a professional if you have any further questions concerning a specific deal. And I am the VP of Compliance. I'm also a licensed attorney, and also I am a certified IRA specialist here at Quest. I just want to start with discussing self-directed IRAs. So self-directed IRAs are such a powerful tool. It is the core of our business here at Quest, and what we pride ourselves on providing education to you guys for, right? So it allows you to, of course, invest in alternative investments, as Juan mentioned, and diversify your retirement portfolio. The best part about using a self-directed IRA to invest are the tax benefits. So these accounts can, of course, grow tax-free in some situations, and mostly tax-deferred, right? So that is such a huge benefit. And, you know, using it properly, I think, is the key thing to growing your retirement wealth and using a self-directed IRA. So, of course, there is, you know, always going to be a catch when investing with self-directed IRAs. So we're going to go over some of that today. I would say when I say a catch, it just means understanding the rules and restrictions associated with owning a self-directed IRA account. The first thing to note is that when you own a self-directed IRA account, you are the fiduciary to your own IRA, right? So as a fiduciary, you know you have to act in the best interest of the account and make sure that you're making the proper decisions to keep the retirement funds that you have safe, in the same breath, growing it to a sizable amount using, you know, different types of investments and things of that nature. Okay. So this here is a new slide. Some regulatory changes happened last year. It's going through, you know, DC right now, and then in 2020 as well, the SECURE Act passed. So I want to touch on 3 key regulations for this presentation, because self-directed IRAs are such a powerful tool, and we want to do our very best to utilize it properly so that, you know, essentially it's not heavily regulated by the government, or the government takes the ability for us to use self-directed IRAs away. Last year, the Build Back Better Act was a hot topic for us because there were a lot of limitations in that act that would, you know, hinder the ability to use self-directed IRAs. Tons of caps and things of that nature, right? With a lot of lobbying that our industry did relating to this Build Back Better Act, a lot of the IRA provisions did not pass. However, I will say, because it didn't pass, it doesn't necessarily mean that, Washington, D.C. is not focusing on self-directed IRAs. So it is really important to do things properly and follow self-directed IRA rules, IRS guidelines when utilizing your IRA. The SECURE Act passed in 2020. One of the major changes that it did was it took away the stretch IRA for inherited IRAs, right? And then now we're looking at SECURE Act 2.0. Good news about SECURE Act 2.0 is it is expanding the retirement space. It is expanding the ability for us as Americans to continue saving for retirement. So while there are, you know, some negative regulations that could potentially affect our industry, there are also a lot of positive regulations that will impact our industry as well. But at the end of the day, I think if we are following the rules to use our self-directed IRAs, it will continue to be a vehicle that we can continue to use and grow our retirement account. Now, moving into due diligence. Due diligence is so key to properly investing with your self-directed IRA, okay? So due diligence, in its most simplest form, is the reasonable steps you would take before entering an agreement, right? I think the, misunderstanding about due diligence is that due diligence only occur when you or before you engage in an agreement. Right. I, however, would argue that due diligence happened before you purchase an investment, during the lifetime of your investment, and at the end of your investment as well. Due diligence is so important because, this is your retirement money, right? Retirement money does not, come easy. It takes a very long time for you to grow your retirement to a sizable amount. And so it is important, especially with using a self-directed IRA account, to conduct the proper due diligence before you're investing your hard-earned retirement money, with someone that you potentially could meet at an event. Okay. So before, I think this, this is where most of our clients conduct their due diligence before getting into a deal, right? So there are a few things I would recommend that you consider before engaging or purchasing an investment for your self-directed IRA account, okay? The first thing is know who you're doing business with. So we offer a ton of networking events for clients to make connections with people who are offering investments. This is just a way for you to make connections, but the work doesn't stop there to find a deal, right? One, getting to know someone that you are interested in doing business with. I think the most key thing you might want to consider is asking for references. If the individual has been raising money with using self-directed IRAs for quite some time, they will have other clients that use self-directed IRA accounts that may speak to what it's like to do business with this individual. So I think that is very important to consider if you're meeting someone at a networking event and they're pitching a deal to you. Ask for references. Ask if they've done any deals with other Quest clients, and if those Quest clients would be willing to share their experience with you, right? And it doesn't necessarily just have to be with a Quest client. It can, definitely be with other investors that have invested with this individual, right? Also, to get to know that person, you may want to ask for historical data, historical financials, how well their business has done, how well other deals have done in the past. And then you may want to ask for a registration as well, depending on who the individual say they are, whether they're just a private person raising money, or they're an investment advisor that's presenting deals, things of that nature. You want to see if they're registered anywhere, and you can look into any certifications, things like that you might have. Okay. Another thing you want to consider before investing is understanding the recourse that you have in the event that the investment does not go as planned. What does this all entail? This really goes to the core documents of the investment. Every document is instilled in, or every investment is instilled in some documents, right? So you want to understand the terms of those investments, right? You want to work potentially with an attorney before you're funding, 5 or 6 figure deal, right? You want to look into that and understand if the investment does not go as planned. For instance, if it's a note and the borrower defaults, what is your recourse to collect the money that you lent? Okay. Working with an attorney will also help you prepare the documents properly, make sure that the document outline every situation in which you can recover this investment, and that the investment paperwork protects the interests of your IRA. Okay. And now understanding the IRA related restrictions is something I'm going to go on in more detail in the next slide. And then also who we are as Quest and in our role as the custodian, what our relationship is to your custodian, and what, how we can help you with that, right? So when it comes to IRA related restrictions, these are things that you want to understand before you even draft the documents to begin investing with your self-directed IRA. We offer tons of education in terms of what the IRA related restrictions are and what you need to do if you're investing with a self-directed IRA for the first time, okay? I have a link here of our education center. As Juan mentioned, we also have other avenues in which you can, get the education right. Our Facebook page, our YouTube page, please use that as resources if you're investing with a self-directed IRA for the first time. Now, the key restrictions to understand are the disqualified persons, prohibited transactions, and the unqualified business income tax. These are so important because of the implications that it might have on your self-directed IRA, okay? So essentially, you could potentially lose all the perks of your tax-deferred or tax-free benefit if you engage in a disqualified prohibited transaction with a disqualified person, right? So it is very, very important to know. One thing I'd like to note is Secure Act 2.0 actually has a proposal that will make the punishments, or I guess the consequences of engaging in a prohibited transaction, less severe, instead of affecting the entire account as the rules are written now. So essentially, if you conduct a prohibited transaction, your entire retirement account, that specific retirement account, will cease to exist on the day that the transaction occurred, okay? And then you're also going to incur taxes and penalties associated with that. That is a very, very harsh consequence to engaging in a prohibited transaction, right? So understanding who the disqualified parties are, you, yourself, your spouse, lineal ascendants, and descendants, those are the most simplest terms, but it also affects the companies that they manage, control, and are highly compensated by. So understanding those rules and not participating in deals that relate to those parties for your self-directed IRA is something that you really have to keep in mind. And then the unqualified business income tax is not necessarily, something as severe as prohibited transaction. It's more of something that you should just be aware of. While self-directed IRA accounts can grow tax-free or tax-deferred, if you engage in, a business, for instance, with your IRA, you will have to still pay UBIT taxes in that instance. And so it's something that you should just be aware of. It doesn't prevent you from doing that transaction. It doesn't harm your IRA. It's just something you should be aware of. And you should work with a tax consultant at the end of every year just to make sure you're filing the proper tax forms and paying the proper taxes for your IRA. Okay. And then next, I want to spend a little bit of time talking about our role as a custodian here at Quest. Okay. We are the custodian. We only hold the assets associated with your retirement account. Okay. We might have trust in our name, but we do not serve as the trustee for your account. This is very, very important to distinguish. Okay. As the custodian of self-directed IRAs, we offer this vehicle for our clients to invest in alternative assets. The decision to make those investments are our clients and their decision alone, okay? As a custodian, as we've mentioned, we cannot provide any tax, legal, or investment advice, okay? So long as you're presenting us with the proper documents to fund the investment, it's not blatantly prohibited, as the documents state. The client attests to the fact that it's not prohibited in our direction of investment form, right? And then also there's sufficient funds in the account for us to process the investment. That essentially is our role when it comes to sending out funds for an investment, okay? We take direction from the account holder. So unless we have written authorization from the account holder or a third party that's authorized on that account, we cannot just make the decision on our own and act or conduct any transactions in the account. Okay, that is very, very important to consider, right? So if we notice that there is something unusual in the account, of course, we'll notify you. And we'll make every effort to reach out to you, make you aware of the situation. But until we receive direction from you, our hands are tied and we are limited in that regard, right? So we try to keep an open communication with our clients and their account. As I mentioned, we collect documentation. So we review the documentation just to make sure it's held for the benefit of your account. It's vested properly. The vesting is very important for us. If you've ever done a deal here at Quest, you know that we might ask you to correct the vesting if there's something on it that's not proper. The reason for that is we have over 17,000 accounts. Each account is held separately and individually for that individual's benefit at retirement, right? And then that individual might have several different types of accounts here with us. It is fairly common for our clients to have both a traditional and a Roth IRA here with us. And so the vesting is unique to each of those accounts. And that's why we look at that to make sure any investments that you're purchasing shows clearly who owns that account and what that investment is for. Okay, so us collecting the documents and reviewing it, the scope of our review, as I mentioned, is very limited. We just make sure it's not blatantly prohibited. It's an investment that we can administer. And by that, I mean, we have a pretty sophisticated infrastructure here at Quest in terms of record keeping and things of that nature. But there are just certain investments that would require too much record keeping that our system cannot, provide, I guess, the best customer service in that sense. So in those situations, we may inform you that unfortunately that investment is administratively infeasible for us. Okay. It doesn't make it so that, you can't process that investment or anything like that. It just means that we don't have the capacity to hold that investment here at Quest. So you may hear that from time to time when you're trying to do an unusual deal that we don't, quite see often. Right. And then applying incoming payments is very important for us here at Quest as well. This is one of the main things that we do. We collect the incoming payments and we apply it to your account. If you are an existing Quest client, I will say this falls under due diligence, because if you have a third party paying your account, please make sure that they put in the memo line what account it's for and, if possible, what the payment is for. For instance, if you own a note that has principal reduction, we will automatically apply those principal reductions to your account, but only if the investment document clearly states that, right? Like it's an amortized note, a portion of the principal will be reduced every month, and the incoming payment, shows that, right? So that allows us to properly administer your account and do it timely. Okay. And lastly, as the custodian of your account, you will hear us say this often, but we file the reports to the IRS to report how much is in your account and the overall transactions that's happening in your account, right? The IRS is very interested in terms of the size of IRA accounts, right? So we file the Form 5498 each year for all of our clients to show how much contribution was made and what the value of that account is. And then we file 1099s for clients taking distributions from their account. Again, the IRS is very interested in accounts that take distribution because they want to collect the taxes when it's available, right? So our role as your custodian is very limited. It is primarily just for record keeping and to safeguard these assets and keep them separate from your individual asset. Okay. And that's kind of the whole cruxes of an IRA, right? It's a separate entity held separately from your personal assets so that you can benefit from them at retirement. And we essentially serve that function for you, right? We help create that separation between your personal assets and then your retirement assets. Okay. And then moving on to the type of due diligence that you should consider once you've already purchased your investment. Okay, this is just as important as all the due diligence you should do before you purchase an investment, I would say, because sometimes, unfortunately, the person that you do investments with may just go radio silent. Unfortunately, I hear that so often with the clients that we have. And so there are a lot of things that you can do while you hold that investment in your IRA that's considered due diligence, right? Payments. If you are scheduled to receive payments, monitoring your account to make sure that those payments are coming in timely is definitely conducting due diligence. For instance, if your notes, like if you have a note investment and the note document is drafted properly, it will specifically state when payments are due, how much payments are due, and if payments are not made timely, what penalties you can assess your borrower. Okay. And then if the note becomes, goes into default, again, you can go ahead and immediately contact your attorney and seek recourse on that. Okay. So making sure that payments are coming in timely, speaking to your borrowers about how to make out the checks, providing as much information as they can in the memo line so that we can properly apply the payment to your account is very, very important. And again, will help us timely administer your account. Annual FMVs. Annual FMVs is a hot topic in the self-directed IRA world. It always has been and it always will be, only because of the type of investments that we hold. So we hold alternative investments, right? And non-traditional investments, I would say. These investments are not, your ETFs or your mutual funds, your bonds. Those types of investment, you can readily ascertain the value at any given time. You can go to NASDAQ, pull up that information, and you'll have that immediately every single given day. But if you dabble in real estate or you have a self-directed IRA, that the private deals, like private placement, things of that nature, there's not necessarily a value until the sale occurs, right? So for instance, a note, you can say the value of the note is the principal amount, right? For as long as that note is active and you're receiving payments, it's not mature, things of that nature, right? You can argue that that's the value of the note. Now, we do have clients that, purchase non-performing notes or existing notes. In those situations, the FMV is a little bit harder to ascertain. And then, as I mentioned, private placement. So private placement, generally, companies are not spending thousands and thousands and thousands of dollars every year to get a business valuation, right? A true business valuation will tell you how much your business is worth, but companies are not generally doing that unless they're ready to sell or there's a big, corporate structure change that they're considering, right? So when our clients invest in a private entity like that, we have had some issues collecting FMVs, but FMVs is very important because it requires you, because an FMV is an annual requirement from the IRS, right? It requires you to go in and check in on that investment and check in on that investment sponsor, the borrower, see how well that investment is doing, okay? So for these alternative investments, it's not the traditional valuation that you will see. For instance, for private entity investment, we will accept a letter from the managing member from that company. And, the times that our clients have issues giving us or providing FMVs is when, that managing member is not responding or things of that nature. So that will, again, prompt you to do some additional due diligence, kind of figure out why it is that individual isn't responding and what else you can do to try to recover that or get a response or, kind of figure out what your next step is in that regard. Okay. And there are other maintenance that will require you to check in on your investments. I will say some of these things are purchasing insurance. If you hold outright in your IRA a real estate property, you will know that there's a lot of maintenance that goes into that. Okay. First, if you are renting that property, you may have a property manager that is, collecting payments for you. While you have someone hired specifically for your IRA to do that, you still want to check in on your property manager to see, if everything's going properly, if the payments are indeed coming back to your IRA account. Okay. And then, if you own a real estate asset, you definitely want to consider purchasing, hazard insurance or requiring any other type of insurance. For instance, if you have renters in there, you may want to consider requiring that they purchase rental insurance just so that you can make sure the property is safe from any potential damage or harm, right? As a fiduciary to your own IRA, these are the steps that you should take to ensure that that asset is protected, okay? Real estate investments will also require that you pay property taxes. Paying those property taxes on time will save you time and money. We do see a lot of delinquent tax suit notices here at Quest, and we notify our clients to go ahead and get that resolved timely. But what we also do is send out our clients that have real estate assets reminders to pay their taxes, okay, timely, so that they don't face those delinquent tax suits and potentially lose the property and things of that nature. Okay. And so just general maintenance for your account, just checking in, making sure that the assets are properly performing is due diligence that you can do during the lifetime of your investment. The last point that I have on this slide, I cannot stress enough, it is reviewing your statements. So I understand that, unlike your bank account, your personal bank account that you may have daily transactions in, that kind of forces you to look at your bank account, look at your bank statements to see if there's any, anything irregular about that, right? With self-directed accounts, I do understand how it can be, not like as it doesn't come naturally to check the statement, right? But Quest does provide monthly statements for our clients. Reviewing your statements will give you the opportunity to make sure that everything is applied properly. And if it isn't, and if there is some anomaly, you can immediately reach out to us and we will try to make that correction for you. But I cannot stress enough, reviewing your statement frequently is very telling. We provide it monthly, but if you want to at least review it quarterly, that definitely is a way to conduct due diligence as well, to make sure that everything is happening properly for your retirement account. But it doesn't end there. Due diligence does continue. Okay, so we, again, are a self-directed custodian. So unless we have written authorization from our clients, we do not conduct any transactions in their specific account. Okay, so if you receive a payoff for your account, please complete the disposition of asset form. This is the written authorization that we need to close out the investment in your account. Now, if you don't receive a payoff or your investment does not go as planned and it's potentially in default or goes bad, you will have to revert back to those investment documents that you drafted at the beginning of this presentation, right? So you'll have to look in there to kind of see what the recourse is. If you worked with an attorney to draft those documents, it is very simple for you to call up that attorney and have them explain to you what action you have now to try to recover on that investment, okay? And I will say, as soon as you know that an investment is not performing, it is very crucial and important to act. I know it is tough sometimes to realize that, you may have made a poor decision or, it didn't, unfortunately, you did everything right. You did all your due diligence. It just didn't pan out that way. That happens too. But acting quickly, could potentially result in more favorable outcome for you. Okay. Don't sit on a bad investment, because what that will do is you will accrue, more administrative fees here at Quest. And the more time that lapses in terms of filing a lawsuit or going to foreclosure on a note or a deed of trust, things of that nature, it will create more issues for you and will create potentially, more legal fees for you in the future. So as soon as a note is not performing, consult with your professionals to see what the next steps are for you. Okay. And contact Quest. Let us know that, that an investment is not performing. Okay. And we will kind of provide you with our internal process, what we will need to do if you're unable to recover and you have to kind of write that investment off, right? We call that our zero valuation process. Essentially, we collect supporting documentation and we take that investment down to $1, and you can either choose to leave it in your account in the event that you might recover something in the future, or you can take a distribution of that investment at $1. Of course, the dollar allows us to track that investment to show that it still exists. And if, of course, you take the distribution of that investment at $1, if you make anything off that investment or recover anything on that investment in the future, it could potentially be taxable to you personally. So that is something to consider. But as long as that investment is in your IRA here at Quest, it will be held at $1. And so that hopefully does help administrative fees. But contacting us to get the procedure for that, contacting a professional if an investment is not panning out the way that you wanted. I will say time is of the essence in this situation, right? Act as quickly as you can. Contact us, speak to us, and we will explain not only the procedure, but what the impacts of this will be. Okay, so if you, for instance, engage in litigation to recover on an investment, what we do internally is essentially that investment receives a special status. And while it's in litigation, we won't require things like FMVs. If the note is matured, we're not going to request a modification to keep it administratively feasible here in your account. So reach out to us and, we will provide you all the information procedurally for your IRA. But most importantly, if an investment is not going well, reach out to an attorney. If you worked with an attorney to draft the documents, potentially that attorney can help. But if not, a new attorney will help you decipher the investment documents and explain to you what the recourse is that you have under those documents. Okay. And that just leads me here to my summary. Due diligence should be conducted at all phases of your investment, not just the beginning. I know I kind of glazed over the due diligence that you should conduct at the beginning of your investment, but this is so important. Please refer back to the class that I taught last year concerning this. I went into that in great detail, but essentially you should know who you're doing business with. Make sure that you have the proper documentation to support that investment. Work with professionals, right? So an attorney, a CPA, if, for instance, you're engaging in something that might incur UBIT, understanding what the taxation for your account might look like may be one of, the steps to you deciding whether you want to invest or not invest. So again, work with your professional team to understand the investment and how your IRA stands to benefit from that. Do your annual FMV, okay? Even for interest-only notes. We see a lot of clients that do interest-only notes. What these notes are essentially, you lend out, let's say $50,000, at 12% compounded annually, right? The borrower will just pay off the interest every month, right? They will pay down interest. So all that accrues is the principal amount and any unpaid interest for that note. Okay. And in that situation, the fair market value of that note will not change as long as those payments are being made timely, right? So the $50,000 note will be valued at $50,000 until it gets paid off or until it matures. So I know those types of investments, the FMV is very, very simple, but still look into that. What this requires you to do is, again, make sure to see whether your borrower is making the timely payments, right? And if they're not making the timely payments, are you able to collect any late fees? If you are able to collect any late fees, what are those late fees and when are they due? These are, if the terms are written into your note, you definitely want to take advantage of that for your IRA. Okay. So conducting your FMV is the one time a year, that you should definitely be conducting due diligence for your account. Okay. We cannot just close out bad assets. We need proof that you've exhausted all potential recourse as a fiduciary of your own IRA. Okay. So as I mentioned, don't delay contacting us if you know that an investment is bad. We will provide you kind of with the procedure on what to do, and it will help with your administrative fees as well. But simply you calling us and telling us that the investment is no longer performing will not suffice for us to remove that investment. We will need supporting documentation to show that you have done everything that you can to try to recover on this investment. Okay. Generally, like an FMB, because this is, essentially we're removing a big chunk of your retirement account. We do need third-party opinions sometimes to devalue an investment, right? A lot of times it's a letter from an attorney explaining that, all recourse have been taken, or the recourse, may be too expensive, absorbent, and may not be feasible for the client to pursue forward, right? So those are all things that we've seen in terms of opinion letters from attorneys. And lastly, if you consult with a professional before purchasing an investment, it may prevent absorbent legal fees down the road. I cannot stress this enough. If you work with a professional and pay for the professional opinion before engaging in investment and understanding those terms of the investment and how your IRA is protected, once something goes wrong, you can again call that attorney up, for instance, and let them know, you want to invoke specific rights specified in the investment documents that attorney drafted and thoroughly explained to you, right? So please do not wait for an investment to go bad before engaging a professional, especially if this is the first time you're using a self-directed IRA. And before I end, I will say, the self-directed IRAs are such a great vehicle to grow your retirement wealth, right? And we definitely should not take advantage of that. We should be aware of the restrictions associated with them, how to properly invest with them, the type of documents that you need in order to use a self-directed IRAs. These are all things to consider. And as long as we're aware of that and we continue to do that, I think we will have the benefit of self-directed IRAs, moving forward and into the future, and hopefully being able to educate future generations on how to use this really powerful tool. So that is all I have for today. I just open the floor up for questions if there are any.
All right, no questions. Sharon, was kind of like rooting you on, saying verify then trust. Sharon May Disney. So thank you for participating.
Yes.
Everyone else, thank you for joining. Please share with your network. Know this video will be on Facebook and YouTube as well. Again, as I mentioned, if you have any questions, you can email us at iraspecialist@questtrust.com as well. I'll put that on the screen real quickly. And then, yeah, Thi, thank you for your time. Thank you for your expertise. Everyone, thank you for spending some time here at noon, and we hope to see you on the next one. Thank you, guys.